Welcome back to Vantage. We've got a new manager on the show this time. He IPO'd his fund in March 2023. Really good to hear his views in terms of the opportunity he sees, particularly in the UK small and mid-cap area, his thoughts on active management and his hopes for the fund he's launched. Let's go take a look. Welcome back to Vantage. I am delighted to have Laurence Hulse from Dowgate. He is just launched the Onward Opportunities Fund. Laurence, welcome to Vantage. I think it's the first time you're with us. To start off with, maybe you could just introduce yourself, give us a little bit of the journey that brought you to the launch of Onward Opportunities Fund.
Certainly, and thanks for having me. Lovely to be at these really nice Edison offices, actually. I'm quite taken with them. I might be coming around again. Look, I first really kind of fell in love with equities and investing in companies when I was about 16. I didn't really know what I wanted to do when I grew up. I was always quite good at maths and general knowledge at school, and just by pure chance got the opportunity to spend a week at Barclays Capital as a kind of spotty teenager, and realised quite quickly I was far too loud and not clever enough for fixed income, whereas equities were a people story, and that's really what it sort of captured me at that age. And fast forwarding, went off to university, studied at Warwick, and knew it's where I wanted to end up, and again got the chance to roll the dice a little bit really from a personal perspective and join a company called Gresham House at its startup phase. There were 6 or 7 people really in a room not much bigger than this, which was HQ, with no assets other than I think a graveyard, believe it or not. And when I left 7 years later, I left 200 very happy colleagues behind, some friends as well, and they had 7.5 billion of assets under management. And my time there was on the equities team, because that's what I enjoyed doing, and that just meant through that growth trajectory really got the chance to kind of have a sort of dual mandate of learning about investing in small caps from a really eclectic but very talented range of colleagues: Ken Watton, Richard Staveley, Brendan Golston, Tony Dorwood. But then actually got to witness and take part in, at times, growing a business and businesses within it. People like Ben Guest, Rupert Robinson, really built funds and products up from scratch, and that was a fantastic thing to just soak up, really. And that's how I've ended up sort of doing a small version myself in the form of Onward Opportunities. It's an investment company that invests in small caps, and I'm really drawing upon the past 8 years and some of the great things I've learned and some other considerations and thoughts too into a product that's really tailored for sort of high net worth specialist clients, to sort of do what I enjoy for them and deliver absolute returns for them.
We'll pick back on a couple of things there. I mean, we'll talk about other opportunities, but I think it's really fascinating having someone who I would say is going through his formative years, or described his formative years. And I think I always like understanding, what inspires people, what motivates people. So you touched on some of them. I mean, I think Tony's done a fantastic job of growing Gresham. We had Ken here last week, actually. So I heard, his approach to life and sort of the skills he brings to sort of private equity. So touch on, and it's not just the people that you worked with, but I know that your family's had a big influence in the way you sort of think about things. So touch a little bit on, the people who inspire and motivate you.
I think from a really sort of fundamental, sort of deep down, sort of personal perspective, would definitely be family. Both my parents and my grandparents taught me a hell of a lot about sort of hard work, determination, and buying and selling, and they're 3 pretty essential qualities to being a fund manager. Certainly one through the cycle, or dare I say it, trying to launch an investment company during a banking crisis. And we'll probably come on to that more later. Certainly hard work, buying and selling is a family thing, and runs in the family a little bit, albeit not in the city, a very, very different world, although at its core very much a market, and probably one of the oldest ones in sort of civilization. From a more professional perspective, look, former colleagues have really sort of helped refine me and form me into the investor and person I am now. But from afar, people that inspire me or I've certainly learned a lot from, firstly, Ray Dalio. I love the way he breaks down problems and concepts almost into sort of machines. And that's very much how my brain works when I analyse a company. The P&L is a series of cogs where there's inputs at the top, which is essentially sales, and at the bottom, through a number of cogs and widgets, profits come out, and hopefully cash as well. So certainly Ray Dalio, from the way his mind works, his book Principles really had quite an impact on me. Peter Lynch, I consistently tell my own clients I'll only invest in things I understand, because if you don't truly understand something, and in this case a company and how it drives margins and profits, you can never really value it properly. And fund management and stock picking is all about working out what something's worth, buying at a discount to that, and hopefully selling it at a premium or par. And he's very much a big believer in that, and very open about it, which I am too. Those would be sort of the key ones, I think.
No, that's good. It's a good flavour of what's brought you to the. And then I mean, you ended by saying it's something that you enjoy, right? And I guess you were put to the test on that when you were launching Onward Opportunities at the time when Silicon Valley Bank was busy collapsing, etc. Talk to me about why you wanted to launch Onward Opportunities. What was the motivation behind it? And then I guess when you had to dig deep, what kept you going?
So the motivation first, when it was a nice pretty sort of my map on a piece of A3 paper, and everything going to plan hunky dory, would be sort of twofold. I think, again, from my perspective, driven by two things in life. Sort of beneath what I hope comes across as quite a sort of jovial exterior, I'm actually sort of deeply competitive, and that's all about investment performance. Mm-hmm. Okay, so you want a mandate to deliver that.
Yeah.
And then I've on a sort of more rounded perspective, I've always wanted to do something quite meaningful with my life. If I'm honest, this isn't a dress rehearsal. We're only here once, and to do something special, you got to try and throw a couple of Hail Marys and land them. And this is very much the kind of first of those. It's something I've always wanted to do, and it plays to what I've been learning at Gresham House and earlier in life to that. I do enjoy it. I genuinely, you have to. You spend more time at work than anywhere else, and you have to literally bounce out of bed at 5:30 in the morning, and to do that you have to really love what you do, and I especially love working with businesses that we've spotted to deliver value for all, actually, because you're one shareholder of many, and if there's a good outcome, everyone benefits, including people within the business. In terms of keeping going during a banking crisis, look, I think I was very open on the day. This is the hardest thing I've ever done, or certainly became that, and it might have been easy at times to just say, let's leave it and come back after the summer when things are a bit less volatile. But two things kept me going. There's quite a famous quote from a cabinet minister in the 80s or early 90s along the lines of sort of the more I hear pain and uproar, the sort of the righter I know I am, or more correct I know I am. And in this context, it was very clear to me the harder this fundraise became, because of markets being difficult, that meant it was even more important to do it, because the value opportunity with all that volatility was getting bigger and bigger.
Absolutely.
And if you can lay a marker down in that kind of environment, I think it gave myself and my colleagues confidence that when things were better, we could add and grow. And I mentioned family earlier. There is sort of determination and grit in the blood. My granddad was evacuated during the war, not once but twice. He was about 7 years old, I think maybe even slightly younger. He was evacuated to the outskirts of Reading, I think, or somewhere over that way, and really didn't like it, and walked at that age back to London.
Wow! The
first time got a clip on the ear and sent back, but then did it again, and there were moments where I sort of thought, well, he didn't turn around. In fact, he came back twice. So keep going and it'll be okay, and it did in the end.
Yeah. Okay. And it's launched, so the IPO'd at the end of March. Talk to us a little bit about the fund. So core investment philosophy, it's small. You can touch on roughly, what it is today and what you're hoping it will get to. The returns being targeted and really the core pillars of the investment strategy.
The philosophy really is one about looking for change.
Yeah.
I think sort of almost by default, if there's change going on within the personnel or the strategy or the end market that a business operates in, by default, the kind of either something in the P&L is going to change or the multiple the market applies to that. Now that can be good or bad. The changes might make profits or revenues worse, or the market might not like them and derate, but that's kind of the fund manager's job to work out. But it's really about identifying change and really the 5 or 6 key variables within a business that change is impacting either the earnings, the cash generated from those earnings and what it's used for, or the multiple or rating the market's applying to those earnings. And they really are the only 3 things that drive a share price. That is the sum is earnings times multiple plus minus net cash debt equals market cap.
Yeah.
And we apply a sort of, a private equity style proprietary DD approach to understand those things on our own terms. And then we take it to an investment committee, which is quite unusual for public markets, but very common in private markets. Why do we do that? One, look, I don't think anyone knows everything in any walk of life. So it's great to really share thoughts, be challenged on your assumptions by people who really know more and better. There is a value bias. Price you pay is one of the few things you can control as a fund manager. So I think quite a good starting point is looking to buy cheaply. Now, I don't think any investor thinks they're buying expensively, but from our perspective, we like to buy things at a discount to the intrinsic value. That's usually underpinned by things like tangible assets, or a very clear and conservative understanding of what the earnings are, with some upside on that if things outperform. Target returns 15% per annum, absolute.
Okay.
I'd like to think we can slightly outperform that in the early years, really because of where the world and equities have come to. We, on the previous funds I worked on, I think we did 15.2 and 18.2% IRRs, and they started halfway through sort of bull markets, so that was a more kind of normalised return. Back to my comment earlier around the harder it got, I knew it was even more important to get the fund away.
Yeah.
That's because UK equities especially, there are generational lows on relative and absolute terms. I think what's really interesting, a chart I used in the roadshow deck for Onward actually was a really great one that a friend and peer, Simon French at Pembroke Gordon produced on the discount between UK and the rest of the world equities. And as I say, at generational lows, and look, it was a marketing pitch, so I would say this, but I did comment to target investors at the time. Rishi Sunak had just announced that Northern Ireland compromise with the European Union. And it's very clear when you look at the UK discount, it started in 2016 and we all know why. I think we will look back at that Northern Ireland deal and other things Sunak's doing as a bit of a nadir in that UK discount. And literally at the same time I was seeing headlines about UK a backwater, UK the worst, most hated investment destination. This is a fantastic place to do business with fantastic companies. So that is all overhyped to the downside, and actually the data is showing a bottoming of that discount now. I think you've now got 2 years of, or sort of 18 months now, because it was sort of 6 months in, but for Rishi Sunak trying to repair relations with Europe, and then you've either got 5 more years of Sunak, a hung parliament, or Keir Starmer, all of which will continue that trend. So you've really got 7 years now of certainly trying to mitigate some of the negative impacts of Brexit to markets, and I'm sort of quietly comfortable with a bit of a renaissance in UK equity investing, actually.
Yeah, I mean, and I think you tend to take a sort of 3 to 5 year view on a lot of things that you invest in, but what comes across is that you genuinely believe in the opportunity, particularly now, right?
Yeah.
And I'm just curious as to why that opportunity exists. So you've touched on, I mean, that Brexit discount is there, but there's a lot of smart people looking at this market, a lot of smart people. So I too had sort of picked up on the Northern Ireland deal, etc., the thawing of relationships, the fact that things are normalising. And yet you keep seeing these headlines of the UK's cheap, private equity shit, £5 billion worth of deal activity in the last sort of 3 weeks coming in. Why do you think that there is this gap in this market?
It's like everything in life, a bit of a myriad of things, and there is an element of subjectivity to how you interpret it. But from my perspective, UK discount is a big part of it, and the reasons behind that, which we've kind of already covered, so I don't want to bore people to death by rehashing that. I think in small caps, in particular, there is an inefficient market, and it's really been caused by rising costs and rising regulation. Initially, mainly on the sell side, with dealing commissions falling, costs of employees and team members going up. It's really meant that it's just not economical to sort of broke en masse smaller companies. You really need a retainer model to justify doing it, because the trading commissions alone don't cover it. And what that's really meant, by no fault of the broking community, it's just bad economics. You get sort of on average one analyst per company in the micro caps, and maybe nearer two in the small caps. That just means that combined with MiFID II, which further sort of restricts the flow of what little information there is readily available.
Yeah.
Just means that there's a lack of understanding and interest in smaller companies. I said earlier, I won't invest in things I don't understand. Well, if there's no information or very little information about a company, no one's really going to be investing in it unless they go and do their own work. So I think that's a big part of it. Interestingly, on the buy side too now, though, falling revenues and rising costs are squeezing margins in fund management businesses, and one way to deal with that is scale. Look at the GAM Lion Trust deal announced this morning. They're having to grow to survive in some cases, and if your funds are scaling and your business is scaling, your investments do too. So again, not only is some of the natural sort of sell side voices coming away from UK small caps, but some of the buyers have stepped away too, and it literally leaves a gap, and you can see it in the way UK small caps trade at a discount, not only to other parts of the world, but versus other parts of the UK market even. So it's sort of the double discount, if for want of a better phrase.
That's good. That's a really good summary. And so you've got a market which is going to be rich with opportunities, and arguably, I mean, if you listen to from Gervais to lots of people who've focused on this market, think it will lead to some of the best returns in the market because it's neglected. You're looking for companies where you see a change in earnings, which hopefully then leads to a change in the valuation multiple, and of course leads to changes in return on capital, cash generation, all the things that you'd look for. Let's say you find one of those companies, you're convinced that actually I've found something which over the next 3 to 5 years should see the things I'm looking for. Walk me through the actual process of the investment process you go through to get comfort. And you touched on the investment committee, and we can probably just touch on that as well. And I know I happened to be listening to a podcast where I think you were talking with is it Alex Wood, where you both said you reflected on the fact that actually we were on a due diligence visit somewhere in Poland or something like that. Yeah. So it's clearly you do your due diligence and get out on site. So walk us through that sort of process. So you meet something, it's sort of starting to tickle the radar that this is interesting. How do you get into it, and a little bit more to get more comfort around it?
So there's three core sort of pillars to what's the full investment process, and ours is probably slightly more elongated than a typical public markets manager. So I'm going to paraphrase slightly for the sake of the listeners more than anyone else. First of all, you've got to find ideas. That's really mainly done through some quantitative screens we run once a month on a tool called Quest. There are sort of 5 or 6 different really scenarios we look for. Some of them are quite contrarian, but that's because we're looking for change, as I said earlier. And they're really, effectively, they've all got 7 or 8 sort of quantitative parameters that trawl the market for what we're looking for. And you get a short list from each that is then really, it's not a gospel, you couldn't go and buy all the names, but they're a prompt to investigate. And that really is leads into the second pillar, which is a more traditional investment process, i.e. due diligence, really. We take the screen lists, we'll quite quickly do a sort of quick and dirty hygiene check to just rule some things out. It might be the sector it's in, or there'll be some sort of optical factor that means we can quite quickly rule it out. And that really leaves you with what I call the blotter. And those are ideas that we work through in a bit of a sort of decision tree. The first stage is a desktop-based analysis. We will go through the report and accounts, do some analysis using that tool Quest again, but company specific. Well, a bit like you've clearly done before me, we'll go and find a podcast or an interview just to get a feel for the management team and how they tell the story. We'll go through the slide deck. We'll usually pick up the phone to someone that either knows the company or knows the end operating market, but they're not an investor. They're usually a business person or an executive, just to really get a feel for, is this a sensible place to be looking at the moment or not? And if they've got a quick view on the company. And that will really end up giving us a view within a week or so on the team involved, if they seem like quality or not. Do they own shares? Have they been buying shares or selling them? Do we know any of them already? Have we worked with them before? The market opportunity, the strategy the business has to sort of capture that market opportunity, and their business model that strategy is taking to market. And of course, look at the financials and the valuation. That gives you a pretty wholesome picture on, okay, has this got the raw ingredients to make an interesting cake? The cake's not there yet, but it's got potential. But you might go at that stage, we're missing some eggs and there's not quite enough sugar, so we'll leave that one. And that really filters out the sort of goers, and they move from the blotter really then to a sort of what we call deep dive process, where we'll focus on 3 core things: earnings, what are they now and why, what could they become and why. And I say that it sounds really obvious, but I've never met a company that's not told me profits are going up at some point, and that obviously doesn't always happen. And if they do, it's not usually the number they say. So we really form our own view. Starting at the top, what's driving the top line? Why might that change? Is there structural market drivers? Are they hiring a new sales team, going to new geographies, a new product, whatever it may be? Just go and understand it ourselves, like going on site visits to wherever it may be. We won't really invest in a company without visiting the site at least once. Drop down to the gross margin, operating level, and really build our own model on what we think profits could be in 5 years. We'll form a year-by-year view, but what's really important to us is where the business can get to. Life doesn't work in a straight line. It's where it can get to and why, and our level of comfort on that. And that's your earnings number, or your profit target. Similarly, we do a bit of a diagnostic on the multiple. And I've got to say, that's one of the real attractions of working and launching the Onward opportunities at Dowgate. They have a broking division, and a broker's job fundamentally on the sales side is to broke its client's multiple, improve it. So to have them helping diagnose why multiple might be wrong, how it could be improved, and why forms another part of the DD. And then really cash generation is the third cog. How is the business generating cash? Now that's important because cash can't be adjusted like profits, and it can be reinvested. So how the business putting that capital back in the capital base to deliver the next set of earnings and sales opportunities. And we'll end up with a sort of 30-page type report where there'll be a mix of independent references on the company and team, a bit of a sector specialist view on the end market they're in, our extracts from our model, a view on liquidity, both entry and exit. We will form a view on who might buy this office, in year 5, and it gets taken to a committee. They get an early look on the work we're doing, so they're familiar. But as I say, a kind of 30-page document is submitted, really to be torn to shreds by 4, much more experienced and smarter people than I and the team, to really stress test assumptions, share knowledge, wisdom. They'll typically have invested in a similar business before and have some sort of scars or war stories to show for it, leverage their networks, and just to read their investment nows.
Yeah.
I take great comfort from it. I know it's not for everyone, certainly in public markets, but I actually like being tested, and I know I don't always get everything right. No one does really. They might pretend they do. So it's a great way to mitigate risk by filtering out, things you might have overlooked or interpreted in an interesting way, and then really maximise reward, because it allows you and gives you the conviction and confidence to run your winners properly. We're often made to run your losers in the investment world because you settle once it's gone wrong usually. So it's important you run your winners, and having that committee approach where we, on a quarterly basis, not only review new ideas but review how the existing ones are tracking. You sort of re-justify with objective fact why you own something and this much of it, and I've seen it firsthand. It was key to the success of Gresham House Strategic Public Equity LP, the funds I worked on with colleagues at Gresham, because it allowed us to run our winners and to quite sizable weightings at times. But being totally honest, there was one in the sort of spring, early summer of, must have been 21. I was actually operating on my own at the time. A colleague had recently left, and Augean, the biggest holding at the time, great investment some of my colleagues made, was bid for. It was already 18% of NAV because we loved the company, and the easy thing to do as an individual would have been sort of cover my backside slightly and kind of halve the position into a bid. But the math said more bids could come, and the bid was a bit cheap, so we let it run, and I think 8 more bids came or something mental like that. So it's a bit of a de-risker. Actually, and investment's about mitigating risk and maximising reward, isn't it?
So let's say now one of the things. So you find something, you go through this process, and you invest in it. You are an advocate and you're taking a meaningful stake in a company, ideally. You're an advocate that actually you're going to work with the management team. I think you've described it as velvet glove active management, which I really like the term. So it's not you're in the face and about it, but you're working effectively to improve. I think it's more the theory around this, which is that what is the belief that active management leads to improving returns?
Well, it's actually not just a belief or a theory anymore. There's academic evidence that shows a circa 2.5% improvement on return on assets after the intervention of an active shareholder. So the evidence and the data backs this up now. But my first-hand experience of it is it's important for a number of reasons. I think in terms of, as a large shareholder, you're aligned purely to shareholder value, okay? And that's ultimately a board's duty as well. They have a fiduciary duty to shareholders to govern the company. And one of the key ways to govern a company well is to maximise returns to shareholders. And I use that sort of term velvet glove because that's certainly my operating style. If you, in a polished, presentable manner, those investment papers I was talking about a moment ago, they're basically a document on how shareholder value can be improved. And it's data and DD to back it up. Taking snippets from that into a slide deck, into a boardroom, and saying, this is what we spotted and how we think this can be done better, challenge it, discuss. If you do that in a way that presents it as a solution rather than sort of going in with boxing gloves for a fight, it's actually quite hard for a board to ignore you. And it is it's not sort of right and wrong, it's about what's true, okay? That's a big Ray Dalio thing, actually, back to what I mentioned earlier. If you can, make a solid case to a board that there is shareholder value to be unlocked from some very clear actions, using this evidence, they're almost kind of exposing themselves slightly if they don't listen and engage and work with you. And look, fighting's not fun.
No.
In any personal or professional life. So we look for boards and companies that want a solution. Quite like the idea of a supportive strategic shareholder who not only can provide capital but can provide help. It's hard being a small company.
Yeah.
And it's getting harder. There's more and more costs, regulation, political and economic headwinds. It's about working with people. I said at the very start, I love equities investing because it's a people story, and a business is people coming together in one place to try and achieve something, really.
Yeah.
And I think if you align yourself to that with evidence and objectivity, and make yourself part of the solution, not the problem, you can deliver some really fantastic outcomes. And I think there's a temptation at times. People sort of get ideas of grandeur and think as a shareholder you're kind of running and saving the business. We're not kind of white knights or anything like that, but we just have some sensible ideas on what might be done around return on capital or margins, or we've identified your multiple's got this sort of overhang on it, do this about it.
I think you mentioned something you invested in previously at Gresham House, EMI, as an example of this, where you'd spotted a corporate governance sort of angle in terms of how you could perhaps improve it. Maybe to turn it into something which people is a little bit more tangible. Go through that what was the issue or that you spotted, and how did you convince them to make a change?
Yeah, issue's probably a strong word in fairness, and look back to what I just said. It was sort of changes around the edges, but at IMI Mobile or IMI Mobile, it was a fantastic company.
Yeah,
was massively misunderstood and underinvested in the market. It was a fast-growing, I think 20% EPS per annum they did every year for 5 years after he held the stock. It was a fast-growing software business with structural growth drivers, trading on 7 times EBITDA.
Yeah.
The sector was on more like 15. And what they did actually, which if you technology comes on at such a pace, but if you go back to 2015, IMI Mobile software was basically connecting businesses with consumers. One of the core and most real-world examples was delivery companies, when you would get a text telling you the driver was coming on this day or he was on his way, and you could reply 1 for, yep, that's fine, 2, leave it in the porch so the cat can eat it, or 3, the neighbour, or 4, come back tomorrow. That kind of stuff. And I think that they did something similar with Barclays around customers as well. That was fantastic. So smartphone adoption was massively growing, and it played into that. Businesses wanted to increasingly use that and other digital methods to communicate with their customers. Mm-hmm. And it played into the online shopping boom as well. So really interesting business, but was trading on 7 times. So the initial thought was, what have we missed? And back to what I described earlier about that diagnostic part of the investment process, really digging into why the multiple is what it is and what it could be. We observed a couple of things, and one was the founder was still the chairman.
Yeah.
And in some ways, quite right, he'd founded and grown a fantastic business, but he was based in India.
Yeah.
And English was not his first language. So it made it very hard for him to meet and interact with both existing and new shareholders. And we all know that bigger institutional managers and funds, they're quite unlikely to take a meaningful position in a stock without meeting the chair and being able to have a dialogue with the chair. Back to my point earlier about the importance of boards. The chair's the chair of the board, so it's pretty important stuff. And so we very gently explored this with the company and pointed this out. And look, the chair was a big shareholder, which is something we like. So they were aligned. So that they wanted the multiple to be corrected. They were very frustrated with it themselves. So we pointed that out to them and suggested that perhaps Vish become a sort of president emeritus, type role.
Yeah.
Appoint a sort of city-based chair, which they did. I think it was a chap called John Onward from memory. So that was one big change. Another, we observed the capital structure was quite complex. Mm-hmm. So they had A and B and founder shares. Now, investors like simplicity, me included. And if you've got two ideas in the in-tray and one's got a really complex share capital structure to fathom out and one's not, this one gets worked on, this one doesn't.
Yeah.
And that can compound over time. And so we recommended the company dissolve those shares, which they did. We thought the broking could have a bit of a, not refresh, but sort of turn on the afterburners a bit, because there was a really good story here that needed to be told even more. So I think Whitman Howard were the broker at the time. We got them to appoint Investec as joint broker. Roger Phillips did a great note on it, which really got the ball rolling. And then Singers came on the ticket as well and really helped. They did a great job actually getting new shareholders in off the back of the raising awareness. And the multiple, it did some other things too. I think my colleague Graham Bird actually partially rewrote their slide deck for them at one point, because it took us a while to understand what they did. Yeah. But when we did, it was like, this is amazing.
Yeah.
And not just because of those changes, but they definitely helped. The share register churned and rotated and improved. People like BlackRock, Lion Trust came on the register, and the shares re-rated from 7 times to about, I think it was 14.
Yeah.
Part of it as well was fantastic earnings growth that was going on. And then the Cisco spotted what we had and others, and I think bought it on 23 times.
Yeah.
So it was a great early story for me to sort of be a part of in a small way and observe, and it just really brought to life. It's not rocket science, the stuff. You just got to have the energy and the understanding and the know-how.
I think I understand this, but I don't think any large asset management house is going to focus on this kind of opportunity just because of the scalability. But I want to understand, if you had to pitch it, how would you position it so that what makes Onward Opportunities different to other funds?
Truly active management. And look, we're not the only manager that does that, but actually in a world of the tack to passive and away from active management, I think that's really important. As I said to some of our investors on the roadshow, management fees are ongoing, so should the work be. We do a lot of our own proprietary work on the way in, and then once we are invested, we work hard to steward our investors' capital. And that's why we do take that velvet glove approach and work with companies to unlock the value we've spotted. And I think that combination of through the investment cycle being very active, that is fairly unique in the market. I've got some fantastic peers that do a similar thing and actually are real inspirations. I think we just marry that up with, Dowgate's almost a sort of merchant bank type model where we've got an investment side that I sit within. Effectively the old Hargreave Hale team, who are real small cap specialists, and some of them even veterans, but they'll tell me off for saying that. Married up with a corporate finance division where, in fact, actually right now there's a deal I'm looking at where that corporate finance technical knowledge has been really powerful in terms of working out a situation and how to play it best for our shareholders. And then once we've got in, maximise the value we spotted with a bit of a sort of in-house toolkit on that, working with the company side. I think when I was at Gresham, it was a purely buy-side outfit. And actually, we were lucky that we had Graham Bird on the team, who was a former corporate financier.
Yeah.
And I was really, really keen to have a similar input here. So I think that's a really weebly answer, isn't it? But I guess I love it and I believe in it, so I've got loads to say about it. But truly active management.
Yeah, no, I believe that, and I think it comes through from what you're trying to do and how you describe making a difference. I think I definitely understand that. So if you had to meet, what piece of advice would you give to a company? So if a company was coming in to meet with you, what would you tell them in terms of what advice would you give them to say that make you stand out?
God, that's a. It's always a delicate path to tread, because when you're advising companies or giving them pointers, you're usually talking to really smart people who've been working a hell of a lot longer than certainly I have. But if I wanted to give a delicate nudge or suggestion, don't tell a story, come and give us a plan.
Yeah. And
that's partly a reflection of, I talked about Ray Dalio and cogs and machines earlier, but, words are great and you can set the scene, but what investors really want to know is, how are you going to drive your earnings from A to B? And it's not just we're going to do it, it's here's the catalysts that are making it happen. Here's what we're doing next week, or here's who we're hiring and why.
Yeah.
That's the key.
Yeah.
That's what. Just get to the point.
I think that's very valuable advice. It has been an enormous pleasure having you.
Thank you.
I really wish you a lot of luck.
Thanks.
It's an area we're really passionate about, and I think some success stories in this space would be great. Thank you very, very much for joining us on Vantage. It's been a huge pleasure to have Laurence Hulse on the show. If there are other managers you'd like to hear from us, please drop me a line. I'd love to hear your thoughts. Thanks once again.